Hey, welcome back, everybody, to the Presidio Perspective. I'm your host, Dustin and TenBroeck, president of Presidio Capital Management, joined here with Chief Investment Officer, CFA, Jeff Anderson, here in the building today. We're good to be back. Good to be with you, Jeff.
Good to be with you.
All right. Well, it's the first podcast kickoff here of 2022, and kind of timely that we got it going because it's been a wild ride so far this year.
It really has. What did we read the other day? The S&P has had its worst start. The first 16 days or something, the worst start in history.
Yeah, the worst 16 days, I think you said, in trading history to start the new year. So that's pretty unbelievable, thinking of everything that we've experienced going back over the last 100 years before the Great Depression, and here we are in the worst start that we've ever had. So what's causing this? Oh my gosh, it's not green every day. The stock market just doesn't go up. I don't just buy something and then just see it go up the next week, month, year. We've had something change.
Yeah, well, it's all about inflation.
It's all about inflation.
I know you were talking about that a year and a half ago.
Oh, I've talked about it my whole career. Inflation, taxes, market crashes, the big three, right? And so here we got a couple of them at the same time.
Well, we had, inflation you talked about before, kind of eating into your
purchasing power, right?
Power, just your net worth. But we've got a different paradigm right now.
So it's all about inflation. So and it's all about the Fed, right? So Jerome Powell, the Fed, they're going to make some changes to what they're doing with their tool chest to get control of their mandates, right? So let's talk about what the Fed does, right? They have two mandates, right? Help explain those.
Well, the two main mandates are employment and inflation.
Okay, so making sure we have a full labor force, people got jobs, good wages, and then to make sure that cost of goods isn't going up too much, and also very importantly, that's not going down, right? Which is deflation.
Which is even scarier.
Right.
Right.
So let's talk about the unemployment rate. Where are we at today? What was kind of their mandate and target?
Mandate target's about 4%. We're at 3.9. With labor participation being a little bit lower since the pandemic started, maybe inflation or employment's a little bit higher, but that
was like the lowest unemployment rate we've had on record, I remember, going into the pandemic. And during the pandemic, we were having, unemployment readings of 25%, right? So it was like Great Depression era, and it caused a lot of fear. So here we are, fully employed. So that's one mandate. Check the box there. Right. And the other thing is inflation.
Inflation, that magic 2% that they have been trying for years to get the economy to kind of reflect a 2% inflation rate. And what did we clock in at the end of the year? 7%?
On CPI, right?
CPI was 7%.
Highest reading going back 40 years. Most inflation we've had in 40 years.
Right.
So what are they going to do about it? They got to get that under control, right?
They've got to get it under control. I think that regardless, we'll get into what they're going to do, but 7% is not likely to repeat this year. There are supply constraints that are going to alleviate, and some of these things were caused by the pandemic will recede, and I think that the rate in general will come down, but it'll be elevated. So what is the Fed going to do? Well, first off, as you know, during the pandemic, they're out there buying bonds. Right?
Yeah, so those are the two mandates of the Fed, right, is to make sure that we have a good employment number and that inflation is reasonable, right?
Right.
Maybe that 2 to 3% we can say over time is healthy. Deflation, much more scarier if we had. I mean, that's one thing we should know, because I know that there was calls from pundits, during the coronavirus pandemic in 2020 that were saying this is ushering in a new way of life. Are people ever going to drive again? Are people ever going to go back to school, go back to the office?
Stand in line at
Stand
Starbucks.
in line, go to sporting events, right? People were calling for sporting events are done forever.
Right.
Not the case. Not the case. Go Niners, by the way. Go Niners. So we'll get back to that later if we have some time.
I was going to wear my Packers uniform.
Oh, you didn't want to do that. Didn't want to do that. Yep, unfortunately.
Didn't go well for me.
Yeah. Anyway, so deflation was what some people were calling, and that would have been scary because we unleashed the arsenal of the Fed to try to cause inflation. So first of all, that didn't happen. That would have been the worst case scenario, is if the Fed printed all of this money through their bond purchases, kept interest rates at zero, stimulated everything they could with the economy, one could argue. And if we didn't have inflation, that would have been
problematic, to say the least.
To say the least, yeah. I was going to say the end, but let's just say problematic. All right, so we have this inflation number. Good. Well, we printed a bunch of money through bond purchases, right?
Right.
So I'm sorry, I cut you off. You said that was one of their tools in their chest, right, is purchasing bonds, which is basically I'm going to put IOUs on the Fed's balance sheet. Okay, so when you hear about the Fed's balance sheet, it's how much money are they owed, right? I'm going to put cash in the system, right, in the private sector. So it's almost like a printing press.
Right.
Except because there's a term to that cash, it does come back to the Fed. So it does automatically, when those bonds mature, the money comes back out of the system and into the Fed's balance sheet, which then they kick off to the Treasury. So they got $9 trillion on their balance sheet. So that's been a lot of printing. It's a lot of money out there.
A lot of printing. And but maybe more importantly, just to go back just quickly, when you talk about printing money, buying those bonds during the pandemic, markets froze, right? So corporate bonds were decreasing in price, destabilizing the economy. So when the Fed goes out there and takes cash they get from the Treasury, give it to the private sector, here's cash, got a fresh layer of cash to go and invest, stimulate whatever it is, the economy, and we're going to bring that back. We're going to hold on our balance sheet to maturity, and then we're going to continue to buy bonds to keep the economy, getting it back, right? We had, 21 trillion in GDP around 2020. We're at 23 trillion now, but, without the Fed, God knows what GDP would have been. So we put money into the system.
Okay, so now they're talking about in March being done with that. No more printing of the money.
Right.
Okay, so
they
that's
were printing they were still buying 120 billion a month of securities.
Right, with inflation.
With inflation.
Okay.
And inflation, they removed their transitory position and realized it's going to be.
So if we have inflation already, and we're running the printing press, that's probably bad.
You're
let's
exacerbating
just say,
it.
right? So we should shut that down. So the Fed's saying I'm going to shut it down. Good. What's the problem?
You're taking away liquidity.
Right.
And markets don't like that.
Okay.
Markets trade better with liquidity.
Or they don't care about the valuation.
Well, we'll get to that at some point. But yeah, that's a good segment to get into a little bit later about valuation, why it matters.
Yeah.
But yeah, so the Fed getting back to their mandate with inflation. So they went from buying 120 a month to reducing it by 15 a month, and all of a sudden they realized inflation's running a little bit hotter. So what do? They said, we're going to move that up. Instead of being done by the end of 2022 or the middle of it, we're going to get that done by March.
Okay, so they sped that up, meaning, okay, inflation is less transitory than they originally thought. It might be a little bit more here to stay. It might be more than they thought. So that's, I think, causing the capitulation in the markets, right? The Fed's kind of changed their tune about inflation.
Right.
And now what we hear is the rate hikes are coming.
Right.
Now money is going to actually cost something. It's not free anymore, right? There's the federal funds rate, essentially the rate in which banks lend money overnight, right? So there's a cost to these dollars and transactions and volume, and it kind of ripples through the system, right? And so there's a lot of differing convictions about how many rate hikes there's going to be. Are there going to be one at a time, two at a time, right? The Fed's going to have their quarterly meetings. And so, I mean, what are we hearing out there?
Well, September, October of last year, they thought maybe you get one or two rate hikes coming into 2022 or for 2022. And then it just gradually started increasing, thinking, well, inflation is just continuing to stay elevated and the Fed's behind the curve, so to speak. And then all of a sudden it was 2 to 3 hikes. And then in the beginning of January, which really kind of created the sell-off, was all of a sudden the futures curve was measuring in 4 to 5 hikes all of a sudden. So what do we say about the markets? Like surprises, earnings surprises to the positive are great. That drives prices higher, not just the earnings growth, but the surprise to the upside increases valuations. It's a
surprises can help or hurt.
It can help or hurt. So negative surprises on the interest rate front, making the cost of money not free and even more expensive than you thought. It's a negative surprise, and the market doesn't like that. And so we're seeing the ramifications of easy money policy reversing.
Right. Okay. And so now, I mean, we're seeing certain areas of the stock market get beat up more than others, right? And so we have interest rates are going up. And so this kind of gets a little heady of why that matters, right? But essentially, like, you have options. If you we remember, some of us, a time when you used to have interest you earned on your deposits at the bank account. There was a time where that happened. Yeah. It's been a long time. But, what are you going to do? Well, I can go lend the money to the Treasury at 1.5%. I could keep it in the bank and earn 0. Neither of those sound that great to me.
No.
What am I going to do? Essentially anything else. Buy the S&P, buy the Qs, NASDAQ stocks, right? FANG stocks, houses, Bitcoin, meme stocks, NFTs, what else are you going to do, right? And so it kind of like valuations got pretty stretched is probably an understatement.
Right.
So we've had different pockets. Why do some of these stocks in the stock market and certain types of bonds too, but let's focus on the stock market. Why are some stocks getting punished more than others?
Well, particularly growth stocks and stocks that don't make money. But if you talk about just specifically about growth stocks, what is it about a growth stock that makes it inviting or appetizing to own? It's because they're growing at a higher rate than value stocks or the economy in general. GDP is running at 3%.
So it's the future earnings that I'm excited about with growth companies.
And the future earnings, they're growing. So let's just say you're earning $1 now, and in 10 years you're earning $20.
Okay.
Well, when interest rates go up, remember, the stock market is a discounting machine, right? It takes all the future earnings power and it discounts it into today's dollars.
Okay.
Well, you have a discount rate, whatever that metric may be.
Yeah, it's a long algorithm.
Right. And so when rates go up,
that's one of the factors.
Goes up,
yeah.
And it brings the present value down. So if most of your earnings are way out in the future,
yeah,
and rates are going up, you're discounting it back at a higher rate, and you're bringing the net present value down. It makes it less valuable.
I mean, so it kind of brings down the demand for those, right, as well, right? And because you kind of have options too. I mean,
There are companies that do well with interest rate hikes.
True. But I just think of like early in my career, which is not as early as yours, but still.
You love to bring.
I do like to bring that up. I do, but you know, I remember my first couple of years in the business, educating my clients about a diversified stock and bond portfolio, and why they should invest and how it could perform over the long run, and where the growth and the safety and whatnot, growth and income, different styles of investing. But they were making 3%, 4%, 5% at the bank in CDs. Like if they did nothing, they just sat in cash at the bank and they made 5%. And we were saying, hey, we could do better. I mean, that's a totally different conversation, right, than investing at zero.
Well, not only that, let's get back to inflation. I mean, inflation running at 2 or 3%, you're still, in real terms, ahead of the game.
Yeah.
Now you're getting nothing
right
at the bank, and CPI clocked in at 7%. We've all been to the grocery store. We've been to the pump. We've looked to buy cars. You're earning negative returns.
Right.
So where has that money gone? It's gone into stocks, and we've had a heck of a run since the pandemic lows.
Yeah. Okay. So the valuations on those high growth companies are coming down because the discount rate is going up. And we haven't determined what that is, right? So this is all just theory right now because we haven't had our federal funds rate hike yet. Right. So this is all just comments about, the market trying to look into the future, right? It's a discounting machine. It's also a fortune-telling machine, one might argue.
Right.
Because they're pricing in everything right now. Everything that they think is going to happen over the next 9 months, you would think that the market has already priced in, right? And so different pundits are out there calling for, it's not 2 or 3 rate hikes anymore that we thought last year. And when that conversation started to happen, it's more, you saw the market start to sell off, right? Oh, the discount rate's going to go higher. It's faster. We're going to take the punch bowl away, as they say. And so I don't know if it's 4 or 5. Some people say, some people are saying 7 or 8. I mean, this all comes back to just your view on inflation, though, doesn't it?
It does.
I mean, the Fed's not going to have a mandate to do 4, 5, 6, 7. I mean, they changed their mind. They changed their mind last November. That's why we're selling off. They can change it. And so they're going to do what they need to do to solve their mandate.
Right.
They got to make sure it doesn't hurt the employment market, and they got to make sure that they keep inflation at that 2 to 3% number.
And they want to keep the economy going.
And so they're going to do it a little bit at a time.
Right.
And so I don't understand why we have to guess what the market's going to, or what the Fed's going to do, because they're going to do it until they get into their inflation mandate.
But that seems to be the name of the game for a lot of strategists and the firms that they work with, because if they guess right, they make their clients a lot of money. They go back on CNBC and they can their fortune-telling
It's
machine.
A lot of short-term thinking, though, isn't it?
Right.
I mean, if we're long-term investors, this doesn't really matter.
No.
I mean, it really shouldn't matter. I mean, what's happening? Okay. I'm going to go with my analogy here, right? Because this is the best I can explain it. I mean, there comes a time in all of our lives, hopefully, or our kids' life. Some of you probably still need to listen up and cut make the cut already. But, whether it's after high school, college, your early adult years, or for some of you, maybe you cut your kids off when they're 37, 40 years old. But there comes a time when you have to say, all right, son or daughter, I think you got it. Go on and make something of yourself, right? And it's kind of like what the Fed is. I see the Fed as like mom and dad helping us, and they've been giving us an allowance for a long time. Call that the bond purchases. Hey, I'm going to keep you going every month. I'm going to give you your allowance no matter what.
Right.
And I got to make sure you have a good job, that you have a strong balance sheet, that you don't owe too much debt, that your interest payment and that your cash flow, you can service the debt if you did have any before I cut you off. But I'm going to make sure you get your schooling, that you're going to get a good job, that you're going to be okay, you're going to be on good footing before I cut you off. And here we are with a very healthy economy, right? Growth has happened. We're having inflation. We're having wage growth. Okay, consumer demand is strong. Balance sheets are strong. Debt levels are low. Savings rate levels are high. Corporate balance sheets are strong. Banks are strong. So the Fed's saying, guess what? You're going to be just fine, kid, and no more allowance. We're like, no more allowance? Yeah, starting March, no more allowance. Okay, but you're still paying my car insurance, right? No, we're not going to pay your car insurance either. You have to pay your own cell phone bill too. And find some healthcare insurance too on the exchange.
Right.
So here we are, and they're like, how can I do that? You got a good job. Your balance sheet is strong. Your cash flow is strong. Your savings rate's high. We're having some inflation finally. We're not worried about deflation. And so aren't we going to be okay? I mean, isn't this just everything's good? I mean, we got to at some point get off this train of good news is bad news and bad news is good news.
Right.
And that's all Wall Street wants to hear. If there's good news, oh my gosh, that means mom and dad are going to cut us off, right?
That's a good analogy.
I mean, it's the best I can understand. And so it's like, what are you going to do? Oh, I don't want to get a job because then my mom's going to cut me off.
Right.
It's like, well, how about you just go ahead, get a good job, you got it, and you're going to be just fine. You're going to be just fine. And you know what mom and dad also say? And what this Fed is also saying? Hey, if it ever gets really bad, you always have a place to stay.
Yeah.
Right? If I'm wrong and you're not going to be able to make it on your own, don't worry. Come on back into the fold. I'll pay your car insurance again. I'll put you back on our family plan for mobile, and I'll start your allowance again.
Not sure they'd be happy about that.
But
doing it,
they have proven time and time again that they're willing to do it, and the market knows it.
Right.
And so, I mean, I think that this is a little overblown as far as the headlines are concerned. But we should expect some more, in my opinion. I mean,
well, it would be healthy.
We should expect some more volatility in the stock market. I don't think this is done, right?
No.
I mean, I think we're still, but it's short-term thinking,
right?
Right, and so that kind of gets back to what to do and what not to do.
Well, one of the things not to do is, I think you had a good analogy or a couple points you made, which was worrying about every Fed speech, every rate decision, every GDP print, every unemployment print, everything that you see on CNBC.
Right.
If you worried about that every single time, you would be
paralyzed.
Yeah. You wouldn't know what to do.
Right.
You wouldn't do anything.
Yeah.
You'd probably sell everything and go live in a cabin in the woods and cut yourself off.
Yeah.
But that's not reality. And kind of brings us back to that Fidelity survey that we talk about, right? And I think you've got an interesting point about Magellan, the Magellan Fund, but they did a survey at Fidelity looking at the best and worst performing accounts, and the best performing accounts were the deceased accounts that nobody knew existed, that might have been invested in Peter Lynch's Magellan Fund.
Right. So they weren't checking their statements.
They weren't looking
they were
because
deceased.
Nobody knew it existed.
Right.
Best performing, and we all know what the worst performing accounts were. They were the day traders.
Yeah.
And that's not to say there are people that aren't successful doing it, but in
sure.
general.
But that's a tough game, and that's when you're worried about what the Fed's going to do, right? I mean, if you're making 30-day or one-day investments, I mean, then you have to pay attention. If I'm looking out over the next 5, 10, 15 years, I mean, how many Fed meetings are there going to be? I know if I'm investing for a 10 or 15-year period, I'm going to experience multiple recessions. I already know that. I'm not going to try to call it. First of all, it's impossible because you have to have two negative quarters of GDP growth to even be in a recession. So and that data doesn't come out for 90 days after the quarter. So you're 9 months into a recession or probably out of it. In the last recession, we were out of it before they could call it a recession.
Right.
We kind of knew, obviously, with 25% employment and everyone staying at home, that was going to be if you're anything besides a streaming entertainment service or or a bicycle with an iPad attached to it, you were having a difficult time. But so yeah, I mean, what not to do? I mean, well, first of all, we had the FOMO phenomenon over the last couple of years, right? Where just things were going up and there was a fear of missing out. So people were buying things that they weren't understanding what they were buying, right? And you could have good companies, but it kind of matters what the cost is, right? I mean, I could get a cup of Starbucks and say, wow, this is good coffee. Some argue it's not, but most say it's a pretty good cup of coffee.
Right.
Maybe some people say it's the best cup of coffee. And for that best cup of coffee, I'm willing to pay $2-3. And then they're like, yeah, you know what? It's so good. We're going to sell it to you for $5. There's still people say, okay, it's so good. We'll sell it for $10. Probably a couple people are going to look for some alternatives. It's so good. We'll sell it for $20. Who's going to go in Starbucks and buy a $20 cup of coffee in today's market? So that's what happened with a lot of these stocks, is that we didn't care only in the stock market and in cryptocurrency, the crypto market, do people want to buy more when the price is high and buy less when it's on sale.
Right.
You call it stocks and socks phenomenon.
Yeah.
Right. You get 2-for-1 stock deal, but you want to buy 1-for-2 on the stocks.
Yeah, it's the thinking is backwards.
So we have FOMO. So hey, I'm going to buy high, and now we have FOLO, right? Fear of missing out to fear of losing out. And so now I got to get off this train. My stocks are down, and so worst thing we can do is buy high and sell low and repeat until broke, right? That's how we lose money.
Right.
How do we make money? Buy low, sell high. So, however, you have to kind of know what you own, right? This is going to come back to what you can do, right? But one of the things is to make sure you know what's in your portfolio. Why do you own it? What's it doing for you, right? Why are you in this thing? And I think for some investors, unfortunately, they just didn't know. They bought things because they were going up, and that's pretty much the whole basis for why they made an investment.
Right.
Or they liked the company, right? Some people really liked this company, but they didn't look at the valuation that they were paying. And so when you buy a stock that's trading at 200 times earnings, that's pretty expensive. And the difficulty is when stocks go down, you're like, oh, good, I'll buy more. Okay, cool, got cut in half. Now you only have to buy at 100 times earnings. Ooh, that's pretty expensive. Well, it's down 75%. Cool, now it's only 50 times earnings. You got FANG stocks, some of them at 25.
Right.
Are you willing to pay 50 times? So the downside is like almost endless. I mean, it's like, where are you going to find that bottom in some of those individual names? And so that's the importance of diversification, right? Making sure you don't have too many eggs in one basket, but also knowing what you own. If you own good companies, I would argue you should be less concerned about this next Fed meeting and how many rate hikes are going to be this year.
Right. Because those companies will adjust.
Yeah.
And they will continue to thrive. But you're right, absolutely right about valuations. I mean, we had a pocket of time from the pandemic until December 31st where valuations just didn't matter. Yeah. In many respects.
Yeah, it kind of started in November of last year. I mean, it was like I kind of look at some of those names. I mean, with the S&P, it went up to December 31st. But those really growth names started getting punished in that first week of November. And that's when the tune changed on what the Fed was going to do. Right. And so they got punished first. But we've seen silver lining on other places in the stock market, right? Values come back. People care about what the valuations of companies are. Investors might be attracted to dividends, getting paid, especially if we have inflation. I'm not just willing to wait, for a long period of time because there's a devaluation of the money. So we'll see. But important to have, and I think the other thing to do is trust the asset allocation. I mean, I know if you work with Presidio, there's a scientific process to make sure that, a mathematical process rather, to make sure you have the right money in the right asset classes, right? And where you can take risk. And if you could allocate your risk for long-term investments, there's no way we can track every inflation meter, Fed meeting, quarterly report to make good decisions. Right? There's always the fear out there and the fear-mongering on the news that, I mean, the world's going to end every single day. I can't watch the news anymore. It's too much.
It's too much. But you could also argue that when times are good, and you're watching certain financial news media, they almost encourage you to take more risk at the wrong time. And
I don't know if I've ever seen times are good on the news. Oh, maybe on the stock market news channel.
That's what I meant.
Yeah.
The stock market.
Okay. I was like, what time is that the news has ever said times are good? Gosh, that would be a record phenomenon had that ever happened. I don't know if I'm all in or all out of the market at that time, but something's changing if that happens. But that's a nice world to picture. So staying true to the asset allocation, not selling low, making sure you know what you own, believing in diversification, the asset allocation process, but understanding what's happening. Mom and dad are cutting us off, and we have a really healthy balance sheet. Jobs are strong. Companies are strong. Demand is strong. So, I think we're going to be just fine. And remember, if we're not, gosh, would Wall Street love that? I mean, Wall Street, Kathy would, right? If we overshoot, if the Fed overshoots, right? That's the risk, I think, that a lot of people are concerned with.
You could have two worlds in 2022. You could have a volatile bear market in the first half. They overshoot. They start bringing rates back down. Growth stocks, like the Kathy Wood stocks, just go ballistic. Crypto. What about crypto? You had a good point about that.
Well, I think that look, we'll see. The market seems to have, over the last 15 years or so, loved the bad news because it meant that our allowance is going up. Right? The printing presses are going up. There's going to be more money, and it's going to be easier to make money. So when there's bad news, the market's, during the pandemic, people were like, the market has lost its soul. It's lost its mind. Look outside. I mean, there's literally riots in the streets and structure fires going on during a pandemic. Social injustice, political divide. I mean, it was bad, and the stock market was having record years because it's looking into the future. Right? And so here they're doing the same thing. And, when the market, if the Fed overshoots, inflation starts to come down, and they start to slow GDP growth, risking a recession, that's when they would have to back off, in which the stock market would say, essentially, oh, that's bad news, right? And I don't know, right? We're just kind of theorizing a couple of things, but this is not our words. This is what other people are saying about the possible back half of the year. But if that happened, I mean, what do the believers of cryptocurrency say? That, these federal governments and central banks are going to consistently devalue your currency relentlessly. So you're seeing a sell-off in cryptos as well, right? I mean, more than growth stocks in some places, because they are those long duration assets, right? And where the Fed is kind of keeping inflation at bay. But oh my gosh, if they open up those floodgates again, it's going to be, see, told ya. And I don't know, that could be the winner in that scenario. But again, I don't know what the probability of that is. I don't know what the benefit of guessing how many times the Fed is going to hike the rate, because they're smart. They know what they're doing. They have their mandate. They're going to be checking the readings to see how many rate hikes they have to do to get inflation at bay.
Well, one of the best investors of all time is still with us, Warren Buffett. Does he pay attention to every Fed meeting and every GDP print? He's aware of what's going on.
Right.
But does he panic over that stuff? No, absolutely not.
Yeah, he says he's very bad at predicting it. So if Warren Buffett's bad at predicting things, I'm not going to even try.
Right. Good point.
That's good. All right. Well, so good. Good to be back here, Jeff. We're going to plan to be back every 2 weeks here at the Presidio Perspective Podcast. We are now on demand, so as soon as it's released, you can watch or listen at your convenience. So check us out on YouTube or whatever podcast streaming services you like. We're on just about all of them, huh, Sierra? All right. Well, we'll see you next time. Have an enjoyable weekend. Wear your red and gold. Go 49ers. All right. And a little shout out to Kansas City Chiefs over there for our gal Sierra on the 1s and 2s.
All right.
All right, Jeff. Good
Thanks.
seeing you. We'll see you
too.
guys next time.